Hi, got plans this Saturday? Well, you might want to make time for three power packed webinars that could change the way you think about your money. Samyuktha is going to show you how to stop settling for just 2.75% on your savings. There are smarter ways to grow your money, and she is breaking them down for you. Then at 11 a.m., I'll be answering a big question. Can 100 rupees a day really turns into lakhs tomorrow? Spoiler alert, yes, it can. Join me to learn the mutual fund math behind it. And finally at 12 pm, Sanjay is going to talking about Nifty 50 and India. The world may be turbulent, but India's story has its own local strength, and he'll tell you why. Three topics, three experts, one supercharged Saturday. Block your calendar. You don't want to miss this.
When growth slows, clearly we see that economic growth in our country is on a slower trajectory. We are seeing growth moderate quarter after quarter, and corporate results, which are the best barometer of growth, are only confirming the slowdown. The Q4 result season is actively going on right now. Some of the marquee companies have already come out with their results. Amongst them, the top private banks, the best auto companies, the top global IT companies, India's most valued company, have all come out with their results. And clearly, the trends are hardly anything to write home about. With low single digit growth in revenue and profits, we are probably heading towards the most challenging phase for equity investing. But look at the equity market and you will think all is well. Everything seems hunky-dory. The reason is that India today is now more driven by flows than by fundamentals. What should an investor do when flows drive a market and when they completely suppress fundamentals? It's never easy to invest in a market completely driven by flows. This market is not just driven by flows, it's also driven by what the counter flows do. For example, if the flows are driven by FIIs, the counter flows are driven by DIIs, the domestic institutional investors. So if the FIIs buy heavily, then it depends on whether the DIIs are selling. Of late, it appears that the DIIs seem to be slowing their selling a bit. This is somewhat surprising and out of character. It probably has to do with their own fear of being left out of a rally driven by very heavy FII flows. So the fear that the FIIs will be irrational is also making the DIIs irrational. This is not an easy market to invest simply because both those who manage the flows and those who can provide the counter flows are more inclined to be irrational. When you look at the result season, it's quite certain that valuation should be at least 10% lower than what they are, if not more. Because valuation should be a function of what future earnings is going to be. What is the trajectory of future earnings? If the future earnings trajectory is inclined upward, then higher valuations are justifiable. If the future earnings trajectory is going to be flat, then valuations have to moderate. And if future earnings trajectory is going to become downward, then valuations have to sharply contract. So where are valuations now? on these three trajectories, I think valuations probably have to moderate or contract. It is somewhere in between these two. But the market has no anxiety, or there is no visible anxiety. In fact, the market is showing more confidence where the valuations are almost certain to contract, where earnings are almost completely certain to contract, which is the smaller and the mid-sized companies. When the economic trends turn, the market cannot be simply driven by flows, because eventually fundamentals will catch up. Flows cannot sustainably override fundamentals. We know this because every bubble that bursts happens when it becomes untenable for flows to sustain against weak fundamentals. But India still is a spot of positivity, an oasis of opportunity when compared to what's going on in the rest of the world. We got to acknowledge that. The rest of the world looks very, very hazy and probably even dark. We are not seeing growth anywhere. In fact, it is probable that China is in a bigger spot of bother than India in terms of growth. I know many will dust up the argument that it's a much larger economy, but you are not going to be given a handicap based on the size of your economy by the global markets. The global markets only want to invest where there is more growth. And in fact, a smaller economy probably has a positive handicap because it has more opportunity to grow than a bigger economy. But the markets are not going to give any sympathy to a larger economy if it doesn't grow. So many of the developed economies are going to see outflows of capital, and some of this capital is coming to the growing markets and the growing economies. In that sense, India is going to receive more flows, that's for sure. How much more we don't know, but one thing is certain, if the flows sustain for months together, then our market's irrationality is likely to be further tested. Its capacity to stretch that elastic of valuation will be further tested. As an investor, if you are very disciplined, it's going to be tough because you are going to be punished for being sensible and disciplined. Those who ride the momentum may have one more last hurrah. But eventually, I think valuations will catch up with fundamentals. So what should an investor do now? I think an investor should be anchored to fundamentals. You don't have to mimic irrationality. At least that's what I have learned as an investor. If you want long-term success, you don't have to mimic irrationality. Whether it's in a company, in a sector, in a theme, or in an economy, irrationality is not sustainable. It may look very attractive in the near term. You may think that, okay, let me play it till it lasts. But chances are, you will be still deeply invested in irrationality after the bubble goes bust. India is not so much a deeply irrational market or a highly irrational market at the headline level, not at the large cap level, not at the overall market cap level. But when you go down, the irrationality keeps going up, and that's the risk of this market. We are in a structurally imbalanced equity market. And when you are in a structurally imbalanced equity market, sentiment can be a huge casualty whenever it is stretched and tested. I expect the test to come but not immediately. So until it comes, the investors, the investment managers, the strategists, the advisors, everybody has to be patient. You have to be very, very disciplined. You have to invest in a very valuation centric way. You must not invest too much money too soon. You must stagger your investments over a period of a year or two. You have to minimize the impact of any sentiment driven event in the stock market. You must moderate the influence of volatility in your portfolio, especially on the downside. I know everybody wants to capture volatility on the upside, but what is more important now is to mitigate the impact of volatility on the downside. So you need to be defensive in your stance, and yet you need to invest in a disciplined way. This is not an easy market to invest. If the market crashes, things becomes easy. But in this market, it's probably difficult. Asset allocation can be a very, very powerful weapon for mitigating the risk. In our ecosystem, we have managed to do it very well when we took a multi-asset approach. Whether it is in investing in mutual funds for others, whether it's doing it for the small investor in Milestones to Wealth, or doing it in Sphere and Neo, which are both multi-asset products in the PMS. This approach gives us opportunity to park capital in asset class which are safer, so that they could be taken into equity later. Today I feel that it makes a lot of sense to scale the safer asset classes and hold money. Last year we did it very successfully in gold. Now we need to do it in another asset class. It's not easy because investors are going to always think about taxation and worry about taxation when they should be actually focusing on risk management. In my assessment, it's okay to pay taxes, but it's not okay to fail in risk management. I would prioritize risk management any day over taxation. In the current scenario, when growth is slowing, risk mitigation, risk management and asset allocation will hold the key to investors who don't like downside. Investors who don't like drawdowns should focus on these three things. When you know it's not an easy market to invest in, should you chase returns? Should you worry about whether you're outperforming the benchmark in a market which is becoming irrational? The answer is no. Your stocks may not participate, they could go down also. But ask yourself the question whether you are in safer stocks. That question is more important today than whether you are in stocks that are going up. Knowing what matters in a slowing economy is extremely important. It's critical, it's crucial. If you know what matters to your portfolio and to your investing in a slowing economy, you will focus on what you need to do and you will not worry about an irrational stock market, which anyway is not going to last. If flows make the headline indices more expensive, not participating in them aggressively is not something you should become anxious about. Don't worry too much, because always fundamentals will catch up, and when they catch up, you should be in a better place. Remembering this is the most important thing right now. Thank you for watching this video.